who is the CEO of Goodrich Petroleum, which is investing lots of money these days in Mississippi. We're very grateful and hope that they are very successful. Mr. Goodrich.
Thank you, Governor, for inviting me. Happy to be here. I'm going to be extremely mindful of the time. They asked me to come and share my thoughts on the world from a small independent producer's perspective and to talk a little bit about the emerging Tuscaloosa marine shale play here in southwest Mississippi. So I'll try to do both those very quickly. Just a few quick comments. You've heard some of this morning. What's driving commodity prices is obviously demand growth. Demand continues to grow across the world for commodities, particularly oil and natural gas. You'll see that demand has grown up to almost a little over 90 million barrels a day. From our perspective as a producer, that means that someone all over the world has got to be finding a new 90 million barrels every day to replace what we're consuming. And to say the least, that is an immense challenge for the world's oil and gas companies. Natural gas is continuing to grow as well. I'm going to break down here in just a minute and show a little bit of more of a macro view of natural gas, particularly as it applies to the United States of America. We focus at Goodrich a lot on exactly where we think commodity prices are going to be and therefore what kind of profit margin we can get from the shale plays that we're in. The shale plays, as you've heard already this morning, really revolutionizing the world, and I hope to share my thoughts with you on that here in just a minute. We heard this morning already, so I won't spend much time on it. You know, employment, direct and indirect employment in the oil and gas sector is growing. Almost 2 million people today. We expect it to grow over 3 million people by the end of this decade. Lots of domino effects. What we learned in the mid-'80s is when the crash came to Texas and Louisiana, everybody, whether it was the local grocery store or the dry cleaner, figured out that they were in the oil and gas business. They just didn't know it. And so now we're seeing the reverse of that. We're having lots of impact across communities where we operate and invest capital. Paying lots of taxes. We'll be over $100 billion as an industry in terms of our taxes. Average tax rate sometimes is portrayed as being extremely low. Actually, the average tax rate for the U.S. oil and gas industry is about 41%. I like to say that we're as, if not the most entrepreneurial company or industry in the world, and that is we respond both positively and negatively to incentives. And so this just shows the price of crude oil in blue, and as the price of crude oil has increased, as we've seen over the last decade, what you've seen is the average rig count, or the number of rigs running in the U.S. has gone to try to capture that increased price. And that works both ways. So in blue here, you will see the gas-directed rig count. That's the number of active natural gas rigs, or those rigs pursuing natural gas as the reserve, compared to the oil. And so in October of 2008, to all of you I'm sure aware, we saw a major economic crash. That crash coupled with a crescendo of supply of natural gas, and we literally saw natural gas prices go from $12 per MCF in June of 2008 to $2 by the end of 2008. And so, not as a surprise to anyone, the rig count, which was running about 1,600 rigs, were pursuing natural gas in the United States in the summer of 2008, has continued to come down as natural gas prices have continued to come down. Crude oil obviously did the exact opposite, and the number of rigs today chasing crude oil is at an all-time high. I like a couple of fun slides here. Conventional reservoirs, because we're talking about unconventional and unconventional growing. Well, what's a conventional reservoir? Basically, a very high quality, high porosity, high permeability. Any one well can typically drain several hundred, if not several thousand acres, and it's kind of like sticking the straw into the soda and just pulling it out. Easy, simple, great. The problem is the vast majority, unless you're going into super deep water, of those types of reservoirs has already been discovered in the United States, and we're left with really tough, low quality, dense, nasty reservoirs to deal with, and that's what an unconventional reservoir is. The hydrocarbons, be it oil or gas, is so tightly locked into this, the only way to get it out is to bust it up through hydraulic fracturing, and that's what we're doing. And any one well here in an unconventional play will typically drain anywhere from 50 acres to maybe, if you get a really good one, 150 acres. So it's extremely capital intensive, lots of wells required to be drilled to extract the hydrocarbons. We saw a shale map a minute ago. The only difference between mine and yours is I got the Tuscaloosa Marine Shale play on here. Otherwise, they look pretty similar. Interesting fact, some people don't know, of the 4 million or so wells that have been drilled in the United States, almost half of them have been hydraulically fractured. So we're dealing with a technique that has been around for 70 plus years and used extensively. What's different? The combination of horizontal drilling plus multi-stage hydraulic fracturing. And how do we do that? Well, we get up on the surface, we drill down, we go down, in the case of the Tuscaloosa Marine Shale, about 2.5 miles vertically, and then we turn at a 90-degree angle and we drill out 1 mile to 1.5 miles. And along that 1.5 miles horizontal, we'll have anywhere from 20 to 30 different individual frac stages. So that fracking becomes a huge component, not only of having success, but also of the cost. So in a typical Tuscaloosa Marine Shale well, we may invest $13 million per well. $6 to $7 million of that 13 will come from hydraulic fracturing costs. Let me go back and say one more thing. What we'll do from this type of a pad is, this is a one-off developmental well, but we'll go back to that same pad ultimately and drill probably 8 to 10 wells off that same pad. So we reduce the footprint, reduce the impact on the environment, save more of the governor's pine trees in Mississippi, and really get leverage off of that. It's great for the environment, great for the area, and great for us because we can start to amortize costs from one central location. Spend a second talking about natural gas. The conventional older reservoirs are the ones that are declining. The unconventional supply, mainly coming from the shale plays, is obviously what's growing, and that trend, I think, is going to continue. You're going to see the unconventionals and the shale be the dominant part of the natural gas picture in the United States here in another few years. So the price getting up to $12 per MCF, gradually, it really started in 04, 05. It basically was every single year the price of natural gas from 2004 through October of 2008 was higher than the year before. That provided incentive to us. Companies got out, went to work, began to drill more and more gas wells, and guess what? We got more supply. The funny thing is, the rig count has effectively collapsed, but supply has continued to grow. And many of us have been scratching our heads for quite a while as how in the world can the rig count collapse when supplies continue to grow? Well, the shale plays are very, very prolific. They're better than any of us thought that they would be. The Marcellus Shale in particular has been a monster growth engine for natural gas supply. And we've had enough associated gas from oil-directed drilling that's kept the supply up. Can this stay up forever? Maybe, but if we break down what's really going on, and this looks at year-end 2012, to the estimate for the end of this year, what you'll see is, as you would expect, when gas prices have gotten down and they're hovering in the $3.50 to $4 range, frankly, not high enough to sustain broad gas-directed activity, in my view. And in our company, we've drilled approximately 100 Haynesville shale wells between 2008 and 2011. We have not drilled a gas well since the fourth quarter of 2011. And if we have our way, we won't drill one next year either. And so the Haynesville, a really great play, is actually declining, and we're going to be down in the Haynesville about 1.5 BCF per day of production from December of last year to December of this year. East Texas Cotton Valley, legacy gas area, also declining, going to be down about 0.5 BCF a day. The Fayetteville Shale will be down. The Barnett Shale will be down. However, associated drilling in the Eagle Ford and South Texas is going to be up by about 1 BCF a day. And the Marcellus has just been a monster, almost 2 BCF a day of growth coming out of the Marcellus shale play. So what I like to say is we're not going to see an immediate supply-reduced recovery in natural gas prices. I think it's going to come on the demand side. But what we really need is the Marcellus to slow its rate of growth. And if the Marcellus will simply slow its rate of growth, I think everything else will come back into balance. And frankly, we've heard a lot of talk about what producers need. We won't be drilling gas wells at $4. And I don't expect prices will get much above $6, probably for the rest of my lifetime. I think there's enough supply out there. What you're going to see is companies like ours that as soon as the strip price on the NYMEX jumps up around $5 or so in MCF for 5 years, we're going to go lock down as much of that as we can to make sure we're capturing our margin. And we'll go back to work drilling gas wells, and supply will come back up. So if you ask me, I'll say we're going to dolphin between $4 and $6 for quite a long time. You're familiar with where gas is going. I'll skip that one. We spent a couple of minutes talking about oil. I'm going to try to wrap this up in about 4 more minutes. Crude oil demand, as I said, continuing to rise. It is probably not going to stop anytime soon. And I will say simply because if you just look at China alone, China is in the Asia Pacific. All those people moving from bicycles to motorcycles and cars is having a profound impact. And I think China in particular is going to continue to grow in its demand, and the world's got to try to figure out how to supply that. As prices have risen, I showed you the oil-directed rig count earlier, and guess what? We've turned the corner from a country that has been seeing decreasing amounts of crude oil being produced to actually increasing over the last few years, and as such we've been able to have a almost direct offset in the number of barrels of crude oil being imported. Most of the shale plays that are producing this oil, be it the Bakken or the Eagle Ford, are producing light sweet crude. We're going to see by the end of this year light sweet imported barrels of crude go effectively to zero along the Gulf Coast. So one of the questions is what happens to all the light sweet barrels when there's no more coming in? The refining complex is going to have to adjust, in my view. If not, you're going to see some pressure on crude oil prices, and if you do, activity will slow down accordingly. Let me spend a couple of seconds talking about us before I jump into the Tuscaloosa Marine Shale. We're a New York Stock Exchange listed company. We're headquartered in Houston, Texas. That's probably all you need to know. We're, as I said, traded on the New York. Market capitalization just under $1 billion. And we're a company that's 25% owned by management and the board, so we're a exceedingly shareholder-friendly company. This year we'll spend about $230 million in the Tuscaloosa Marine Shale. We'll spend almost 30% of that. We did buy out Devon Energy's position here recently, so that's concluded in our acquisition piece of the budget. But you're going to see us transitioning capital away from the Eagle Ford, where we spent over $100 million this year, to the Tuscaloosa as we get into 2014. So this is why I was invited. Let me share our views of the Tuscaloosa Marine Shale play. It's in southwest Mississippi, southeastern Louisiana. It's an oil shale play that's fairly deep, covers almost 2.5 million acres. Pleased to say that we are currently at least the largest operator in the play with a little over 300,000 acres. We got in very cheap. Our balance sheet has never been big enough or strong enough to let us come behind others, so we have to be nimble and quick and use our geologic expertise to try to value risk and move early. So we're in pretty cheaply. We've got about $60 million invested in the acreage at $185 an acre. It's a deeper shale play than most. We're between 10 and almost 15,000 feet. The Tuscaloosa is about 100 to 250 feet in thickness. It's light sweet crude, 40 to 45 degree gravity, and the production stream is almost 95% black crude oil. The same red halo you just looked at is on this map. Our acreage is in yellow and orange. The Devon position we just bought out is in orange. Our 135,000 acres we had before that is in yellow. So you can see we're scattered right along the border between between Mississippi and Louisiana. I'll point to just a couple of wells. The well that really set this off was in Canna's Weyerhaeuser 73 well, if I can figure out how to operate this. And I guess there it is, which sits right on the border. This well came in with is about a 5,000-foot lateral. They did 17 frac stages. That was really the first, what I call grassroots well, where they gave a bona fide attempt to be economic. And that well came in at 770, almost 800 barrels a day for its initial 30-day average. And that fit perfectly in our thesis of what was going to be required to make an economic play here. So there's been a good bit of activity since then. We're pleased to say we've got the best well in the play so far, which is here in Wilkinson County. Our Crosby well IP'd at about 1,300 barrels a day and averaged almost 1,100 barrels a day in its first 30 days. I'm not going to go through much of the history. I will simply say that the play's been around for a long time. Everyone's known the Tuscaloosa was there. The challenge was that the clay content was a little bit higher in this play, about 40 to 50%, and people thought it was too ductile, too much clay. You couldn't either propagate a frac, or if you could, the fracs would not hold up. And we have now proven that that's not the case.